Hey, good evening, everyone. This is Mark with Right Line Trading, and for some reason, GoToWebinar did not render a recording of the webinar I just gave. So what I'm going to do is I'm going to make a copy for all of you that did not attend, and for some of you that would like to view some of the slides again. Now, I'm going to run through it a little bit quicker than I did during the webinar, but I believe that you're going to get a very, very good feeling for exactly what the indicators I'm going to show you do and how they can help your trading. Now I'm going to begin quickly with this disclaimer as required that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures or forex markets, nor for any profits or losses that may be incurred. Participating in trading in the markets involves substantial risk, and it should be understood that a person can lose a substantial amount of money. Therefore, this kind of investing is not for everyone. Careful consideration of your financial position should be made prior to trading. None of us here at Right Line Trading are registered financial advisors. We're not licensed commodity trading advisors. Now, with that said, what I want to do is go over the standard volume assessment. And this is an indicator that you can find anywhere. You can get it on NinjaTrader. It really does nothing special except tell you how much volume has accumulated underneath a candlestick. Now, it does not matter the kind of candlestick that you're looking at. This happens to be a range candle. And we're doing a retrospective analysis. And I see people doing retrospective analyses looking at this kind of volume determination commonly. But it's really not providing you with any useful data whatsoever. Although right here, there's a spike in volume, we do not know how long it took this candle to form. Remember, if the power of the bulls and the power of the bears is essentially equal in this candle, it's going to sit, and it may take 5, 6, 7 minutes to form, close, and for the next candle to be created. So this volume spike may not necessarily be due to a large surge in volume. It could just be due to the fact that the candle takes a long time to form. This type of indicator is really dependent upon two variables. One is volume, and two, the rate of candle formation. We should not have to care how fast the candles are formed. We want to know how much volume is driving price. Here's the same analysis, looking at up-down volume. And you have the same problem when you do a retrospective review. Even when you're on the right edge, the amount of volume that accumulates under a candle, whether it's range, tick, Unirenko, Renko. Now, time is a little bit better, but still has problems. Could simply be due to the fact that you're accumulating a lot of volume underneath a candle that takes a long time to form. So you really do not know how much volume is driving price at any given particular moment. That's something that we can't have if we want to use volume to trade with. Now, there are only two things on any chart. There's volume and there's price. There's no other in-between metrics. So we need a really good analysis of price to help us trade. Now, the first indicator that I'm going to show you is called the volume hammer. And it's this lower analysis here. Now, this is telling us how much volume is crossing per minute, per unit minute of time. and could be set for a minute, 2 minutes, 3 minutes, 4 minutes, but this moves independently of candle formation. There's no candle formation component time here. So we see that volume spikes right here and drives price up off of support. Now, this is the value of the volume hammer. It does not make any difference if these candles are moving fast or moving slow. This is moving at its own independent speed. You could get 5 lines crossing under one candle or 1. It does not matter how fast these candles form. You set the speed of the volume hammer. And you can see, looking at market replay data, we got a spike under this candle, which pushed price right off of support. Here's another example. And these are both really good examples. Price here is in consolidation. It's moving sideways into support. And you can see the spike in volume on the volume hammer. And it drives price up into consolidation again, and then up for a nice long trade. Here is that spike in volume we're looking for, with price in consolidation that drives price up off of support. So it really does tell you when institutional traders are pushing more volume across, and essentially this is the fuel that ignites a nice movement in price. And it does not look at the rate of candle formation. It is moving at its own pace across the chart. The only way that you can create JPEGs like this or do an analysis retrospectively is you have to look at market replay data, because the candles are forming at one speed and this is moving at another speed. And you can see price is in consolidation here. You get a huge spike in volume. And it doesn't move price yet, but you can see eventually this real sustained drive in price eventually sends the market down. Now, price usually breaks out of consolidation in the direction of the trend. And with the 50 down and the 15 down, a spike in volume almost always sends the market in the direction of the trend. Now, this is simply a 50-period simple moving average, and this is simply a 15-period simple. You can use any moving averages you like, but I recommend the 50 and the 15. And here's another move. Right here, you get a volume spike, but there's just nothing to trade here. The candles are right into resistance of the 15. Here, you get a move into consolidation, a volume spike, and a break of consolidation to the upside. Now you can see that these create very consistent, low-risk trade entries that are very, very likely to move in your direction. That's the power of trading with raw volume that's independent of the rate of candle movement. Now, as far as I know, this is the first time this has ever been done. Here's another trade. We get a spike in volume here, and we do get a continuation move, but there's just nothing to trade. Spike in volume here again. There's nothing to trade. Remember, we have to be above the 15 and the 50 to take a long trade. Here, we're in consolidation with a drift back to support. And boom, up goes the volume hammer. Sustained increase in volume, and price is lifted right out of consolidation to the upside. Now, this happens consistently over and over again on every single market. It doesn't matter what kind of candle you trade, whether it's range, Renko, time, tick. It doesn't matter what market you trade, stocks, futures, or Forex. Volume drives price, and you want to take a long trade when the 50 and the 15 are green. And the best trade is off a pullback, on a spike in volume, or at a consolidation on a spike in volume. Now, here's a multi-channel assessment. Now, the more channels that are created, now the indicator does all of this work for us. We don't have to do this analysis, and you can see it's a complex analysis. The more channels we've got, the more likely we're going to get an explosive move out. Now, remember what a channel does. It catches traders in both the direction of the trend and in the counter trend direction. Now, since we're below the 50, we define this as an area where we're only going to go short. Above the 50 defines an area where we're only going to go long. So what we do is we've got traders caught short, long, long, short, long, short, long, short, long, short. I mean, we've got a ton of contracts or shares or lots in the hands of traders in both directions. And traders, believe me, are sweating it out here. Because if the price breaks short, it's going to stop out everyone holding a long position. If it breaks long, it's going to stop out everyone holding a short position. We know that consolidation is almost always, I'm sorry, I just moved to the consolidation indicator and I just want to explain it. It's going to break to the short side. Now, I kind of really did. I moved from the volume hammer to the consolidation indicator. I didn't sort of segue into it by doing any explanation. But what this does is, as I mentioned, is it is pre-configured to define a long channel that captures both bulls and bears in both directions, giving you an area, sort of like a coiled spring, that's going to explode out, almost always in the direction of the trend. And you can see that when you get the break of consolidation here on this candle, the 50's red and the 15's red, you get a nice move down. Now, this is a very big candle. I can't remember if this is a range, and I think it's a 21 range. So this is about 20, 40. This is about a 60 or 70 tick move. I mean, this is on a future, but it could be on the Forex markets or it could be on a stock. It is irrelevant. Now, here's another move out of consolidation. Now, the software does the channel, prints after a certain period of time, and it also does a multi-timeframe assessment. Now, you're going to see this about 25 to 30% of the time. It's actually going to give you this green triangle intra-candle. Now, when there's a very special multi-time frame alignment, it's going to signal your long trade at a consolidation. And you can see it's very specific, and it only occurs in certain instances at the termination of consolidation and the move up. When you get it, pay close attention, because it's going to give you a very low risk, potentially high reward trade as this move is pushed up, stopping out all of these traders holding short positions. And what we're hoping is moving in the direction of institutional money who are also buying more long contracts, more long stock shares, or more Forex for more Forex lots. And here's another great, look at that long period of consolidation. Now, I didn't format this right. That red dot is a red triangle. Now, it signaled the short trade a little early. And if you got in on this red candle, you're not stopped out. You're simply moving within the channel. It came a little bit prematurely. You can see how many traders are caught in both directions. And you can see that this is a big move down. Again, this is a big candle. And this is going to give you a very, very big move. Again, now this is on a tick chart. And let me tell you, tick and time work great. You get the sideways movement to support. As soon as you hit support, you take your move long. You've got a great long trade. And you're going to stop out all the traders in this counter trend direction. It's really a terrific setup. It is one of the most reliable setups in the market. Trading out of consolidation in the direction of the trend in a predefined channel. Now, this is an optimized channel that we've worked on for quite some time. If we make it wider, we get less specificity and we get more likely to get a loser. If we make it narrower, so it only requires a few candles to form it again, you're going to get trades out of consolidation that are going to fail. Here, it's a fairly tight channel and requires a lot of candles to print and set and get you ready to take a trade right off the support long. Here's another trade. This one's a little riskier because you've got the 15, but the 50 is just yellow. But you can see you've caught buyers and sellers nicely here. Here's the break and the entry into consolidation, by the way. But then you move up again into consolidation. Now, this may be the end of your move. If you have a large risk tolerance, you're going to get a pullback to support, and boom, a huge move up. So how much of this long move you catch is really based on your automated trade management strategy, but the trade went in the direction you wanted, and it's going to be a profitable trade, no matter how you configure it. Again, same trade. Now, here's two channels. Now, I believe this is on time. You get a sideways channel right to support. Up you go, right into consolidation. You can see there's dual consolidation channels here. Can keep you from taking a trade prematurely. Hit support, and up you go. Yeah, this is time. You can see the size of this candle is huge, and that's the candle you're going to be in. So this is a very profitable move. In this candle, to consolidation, to this candle, all the way up to here. Now, again, here's where the indicator is telling you, go long, go long, go long, because of the multi-time frame setup. Now, you don't have a trade until the 15 crosses the 50 to the upside, and the 15 and the 50 are both green. There's your long trade. At a consolidation, there's your break for a nice move up. Now, you're not going to, probably based on risk, you're not going to let this retrace all the way to support, but you're going to get a nice move up. Now we're going to combine the two. We're going to see what happens when price breaks out of consolidation and validate the trade with a spike in volume based off the volume hammer. Now, here's price consolidating sideways. Now, I don't recommend taking a trade, a counter trend trade. But if you do, this is the most reliable counter trend setup you will ever find. It's not divergence, it's not oscillator divergence, MACD divergence. It is not trading off of a pivot. Whoops, somebody's car alarm has gone off. It's not trading. Better. It's not trading off of a pivot. It's not a double top or a double bottom. I'm telling you, I've been doing this since 2004. The best trade is out of consolidation that's way above the 50 because price wants to regress to the mean. Out of consolidation on a volume spike that tells you that that there's a large spike in price, in volume, to push this trade out of consolidation to the short side. You can see how helpful the volume hammer is in validating a trade out of consolidation. Now here's a terrific trade out of consolidation. And now we have a better idea of exactly where to take the trade. You can see you get a spike in volume intra-candle right here. Here's the break, and on this break of consolidation, you've got a nice plateau in volume. I mean, traders are still pushing this trade. And look at this nice move down. Now, you also get a spike in volume here that helps you take the continuation trade. It's not as prominent as the breakout of consolidation, but it's still a good validation of a continuation trade short. Now, the reason that breaks out of consolidation usually come with large volume spikes is because two things are happening. One, you're stopping out all the traders that are long, and they're selling their contracts. They're adding to the volume. In addition, you're trading in the direction of the trend, 50's down and 15's down. So it's likely that institutional money is helping drive this trade short here and here. When there's no trade whatsoever, we just don't really care what's happening with volume. All we care about is when we're looking for an entry, that volume validates the fact that price is likely to continue in the direction that we want. And this should be a triangle. Formatted the indicator wrong, but you get a green dot. It's telling you to go long, and look at the hammer. It's shot up intra-candle, and this is moving up on tremendous new volume that's going to push this up, consolidation, and up again. So it's a great signal to take as a trade. And again, it's a very low risk, potentially very high reward trade. And our goal as traders is not necessarily to get winners, because we're all going to get winners. You're never going to have a problem getting a winning trade. What everybody does is have a problem avoiding losers. And this trade out of consolidation on a volume hammer spike is a very low risk trade. Here's another one. I mean, this should be an up triangle. Just comes as a dot because of my forgetting to format the indicator appropriately, but you can see it clearly. So it's a system generated long that's validated by a massive surge in volume that pushes this trade all the way up, pushed it right off the edge of the chart. So again, very low risk, high reward trade. Here's the arrow, and here's the volume spike. Now, in this particular case, we looked at this once before. The short signal was not validated by a large spike in volume. It came here. So it allowed us to kind of dance a little bit and let the trade mature, wait for the spike in volume, and then take the trade short. If you took it short here, you're okay. You're not going to get stopped out here. You have no reversal candle. You're still fine. But this is going to give you a trade with a lot less heat because it's validated by this large spike in volume. Another trade right here. This is an enormous spike in volume from basically very low volume to a massive spike on a break, a consolidation, out into consolidation, up into consolidation, slight pullback, and then all the way up. It's a great move. It's always going in the direction you want it to. Here's a short trade. This one is going to give you some heat. You get the spike, but price retreats back to resistance and then eventually collapses. This is a multi-channel consolidative pattern, and the multi-channel consolidative pattern are the most powerful. You only need one, but if you have two, and sometimes you're going to get 3 and 4, it means you've got lots of traders trapped. And you can see the spike validates the move to the downside. And remember, this is tracing out at its own speed. It is not tracing out at candle formation speed. And here's the last slide. It's a great trade. This is a long consolidative period. System generated long comes with an enormous spike in volume. You're going to see this intra-candle. It's going to start heading up like a lightning bolt. And it's going to push this trade all the way up. So that is the system, or that are the indicators. There are two. The consolidation indicator with its signal and the volume hammer combined, no matter what you trade. Now this is available on NinjaTrader 7, NinjaTrader 8. I can download it for you tomorrow, which is Monday, and it's all ready to go. Whatever system you're trading, whatever you're using, whatever methodology you're using, it will augment what you're doing and give you additional, very low risk, potentially very high reward trades. And that is what trading really is all about. Now the offer has been sent to you. I'm not going to go into the offer on this particular short snippet here, but you're going to get time in the live trading room, and you're going to see us trade it, and you're going to see how reliable it is, and what a great pattern it does. This is a very unique indicator. It's never been done, and I have never seen anyone create an automated consolidation pattern that the software does and create a multi-time frame signal to alert you to take the trade out of consolidation. If it's validated by volume, you've got yourself a terrific trade. So listen, everyone, have a really wonderful night, and I look forward to seeing you in the trading room, and I wish you the best of luck. Take care all, and again, hope to see you in the trading room.